How you doing, friends? It is Tuesday, July 18th, and this is the 0 days to expiration final hour show. The purpose of this show is to examine zero DTE strategies and try to figure out which is the best. What is the best way to go? Of course, I want to put a caveat on that. It's one thing to have a strategy and that you think that is back tested or you think that works or anything like that. But ultimately, the thing that makes a strategy work is the work that you put into it, the process that you employ. So while we're going to examine a wide range of strategies throughout this series, this podcast series, you have to understand that not everybody can take that. It's not a recipe. That's what I want to say. That it's not a recipe like you bake a cake. You provide the exact directions and then they follow those and then people make money. That just does not happen. And if it did, someone would have come out with the proper strategy that everybody can follow like a recipe and everyone would be making money. Of course, the pro traders would figure out how to arbitrage it into nothing. So there's a lot more to a strategy, but what we're really looking at here are those strategies that have a wide enough breadth of possible outcomes that are positive and that work. And then assuming that you can have the discipline to trade in a consistent manner and be able to control your risk, then the odds are that you're going to make good money with it. Now, some strategies just reek. And what I mean reek, I mean they stink. And then there are other strategies that have a lot of promise and are easy to use and provide a wide range of benefits that fix a lot of the problems that traders have, things that would naturally get them off their game, huge risks, a lot of volatility in their returns, and anything that will cause them to develop a fear complex. Which there are a lot of things. It's hard to point at any one thing because there's probably 100 things. So we'll start off by looking at a range. We'll define the playing field first of all. We are trying to find zero DTE oriented strategies. And so what that means is that strategies that take advantage of the fact that it is the last day or the final day of expiration. Now, you would think that, okay, what kind of strategies could I do? You want to take advantage of that accelerated premium decay. What other types of situations arise from that? You have extreme gamma risk. That might be another thing that you could play, or all of these things. You have a shortened period of time, and maybe we can be a little bit flexible on that. There are a number of different ways that you could approach it. You could look at a high probability strategy that's focused on making small little wins one after the other and then managing your risk. Or you could look at one that is focused on return, total return, that uses an asymmetric risk to reward strategy. Or you could go somewhere in between, maybe just try credit spreads and take your chances with a 50-50 approach and try to pick direction. All ways that you can go. Now, there are some popular strategies that are out there, and then there are some that aren't as well known. The ones that are popular, I believe, are those that are intuitively attractive to the retail trader. And when I say intuitive, I am not saying that's a good thing. I'm saying that it's like randomness. You look at something that is random and you think you understand it, but then it may show a completely different side of the problem. What I mean by intuitive is that it appears that, oh, because I have a limited set of knowledge or idea around this strategy, a high probability strategy is an example of this, it looks like a good idea that I win over and over again and I lose very rarely, right? But you're not really putting it all into perspective. What does it actually mean when you win over and over again? And what is it like to be in the trade on a day-to-day basis? And do you win over and over again? If a strategy implies that you can win 90-95% of the time, do you actually win 90-95% of the time? And what's the risk that you're taking on? So those are things to consider. On the other end of the spectrum, are things like credit spreads or selling premium. And those are things that seem to make intuitive sense that, okay, I'm going to sell premium. And because premium is decaying at its fastest rate on that 0 DTE, so that makes sense. But what is the total context of the trade? What are the risks involved? Am I going to be put in peril at any point? Because you don't want to be in peril. Being in peril as a trader is really a bad idea. So we'll look at all of these trades. And there's like I said, a wide class of these trades that we can put on. Probably the most popular are the Iron Condor, at the money Iron Condor, and the credit spread. Hey, Dougie. Sorry, the doggies here. They just came in. Oh, both doggies are here. Hi. Nice to see you. So the general premise is that you need to be selling premium as opposed to going long options, or be a net seller as opposed to a net buyer of premium. Now that's a fallacy, first of all. I want to dispel that notion. And let's take into consideration something like the iron butterfly, or the butterfly in general. Now the butterfly is an interesting trade. Butterfly is a trade that a lot of you have probably used for earnings plays. So you know that there's going to be potentially a big move coming out because of earnings coming out for whatever stock, your favorite stock du jour. But you don't know which way it's going to go. But you think it might go positive, or it might go negative. So what you do is, but you don't know how far or wherever it is, and you want to put on a trade that's going to give you a really good risk to reward. So a typical earnings play might be to take that butterfly and put it way out of the money, make it nice and wide so it doesn't cost you very much. And that would be a typical asymmetric trade. And if it does go up there, you make a lot of money. You could also put on a straddle might be another way to go. If you think there's going to be a big move, but you don't know if it's going to go up or down, you can put on a straddle. And so if you have a very large move up or very large move down, then you can make some money. Unlimited reward and a defined risk. Although the risk can be quite big if the volatility is. Those are some ideas. The Iron Condor is probably the most popular for 0 DTE. And let me go to the iPad and we'll do a little bit of drawings and show you what these different strategies are like and how we're going to rate them. So we're going to go to the iPad here. We need to tell the iPad we want to mirror my display. I don't know why that doesn't stay there. All right, so let's create a new screen and let's take a look at the different types of strategies. The ones that I've mentioned so far are things like the credit spread or a vertical. And I'm going to draw the risk graph and what it might look like. So a vertical might look like this. A butterfly might look like this. A straddle might look like this. Then there's a strangle that might look like this. There's the iron condor that looks like this. There's the, let's see, one more. We'll use a calendar spread that kind of looks like this. So what we're missing out of here is where's the zero line. Now typically on a vertical, zero line would be right here. Now on a butterfly, the zero line could be a number of different places. The zero line on a butterfly could be one of two places. It could be way up here if it's an at the money butterfly, at the money, or it could be way down here. Now you see the difference. The difference is in the amount of risk. A lot of risk here, tiny little risk there. Straddle will look something like this. Strangle will look something like this. Iron condor will look something like this. And then this would be your calendar spread, will look something like that. Now, where I'm putting these zero lines is really important because you can see here with, for instance, the vertical. A lot of people are putting on verticals where they're right at the money, so they typically will have a 1-to-1 risk to reward ratio. On a at the money butterfly, it'll be really skewed, but it'll be something like maybe 5-1. Now, there's unlimited risk or unlimited potential profit on the straddle right here. However, this risk can be pretty big. And if you start here in the middle, this width here is pretty important. Typically on a straddle, that's considered a 1 standard deviation move where it intersects the 0 lines. And this risk can be quite big. For instance, in a simple daily straddle on the SPX, that could cost you anywhere from, or that risk could be anywhere from, say, 2,000. That's quite a bit if you do not have a strong enough move where you escape. The strangle is a little bit, it's like the opposite of that. There are 2 different ways that you can do the strangle. This is a short strangle, and this is a long straddle. You can also have a short straddle as well. It looks a lot like the strangle, only it comes up at a point. The problem is that the short straddle and the short strangle both have unlimited risk. So they have unlimited risk. If you go too far this way or that way, you could lose a lot of money. So you have to stay within these break evens, which is typically 1 standard deviation. The iron condor usually is like a 5-1 or even a 10-1. 10-1 is usually the accepted. What most people do, we'll call that 10-1. And the calendar spread also is a huge risk hog. It's typically 3-1. Now, the butterfly, the out of the money butterfly that I have way over here off the chart, that's usually a 1 part risk to 10 parts reward. Now, you'll notice something that's pretty interesting there. It's the only one that has that asymmetric risk to reward in the favor of what you would consider reward, right? Very little risk for outsized potential reward. But there are problems with that as well. So you have all these different strategies that you can choose. Which one are you going to go with? And I know that I just made a hot mess here. There are considerations here. Now, let's take probably the most basic one, and we'll look at the vertical, and we'll look at the iron condor, because those are the ones that most people are using. So we'll start with the vertical because it's a little bit simpler. An iron condor is nothing more than 2 verticals. So we have our risk graph, and we want to put on a credit spread. A credit spread, if we're going to go bullish, then it would be a put credit spread. If we're going to go bearish, it would be a call credit spread. So that the net result of that trade is either a credit or a debit. Now, the difference between a credit and a debit spread is really some conjecture. A lot of people will say that when you put on a credit spread, you're collecting the premium. You're collecting the premium and it's going into your account and it's yours, which is a load of bull. It's not yours. Sure, there's an accounting thing that is putting you or crediting your account temporarily while you have the trade open. But unless you have an unrealized profit that you can close, there is nothing that's yours. Nothing is yours until you close the trade. So you can put a credit on and right away you won't have any unrealized profit. You may have credit, but once you close the trade, the credit goes away. Everything zeroes out and there's nothing. So the idea that a credit spread is providing you with, really, am I having this bad echo again? Are you serious? Are you all experiencing a bad echo or buzzing? So I need someone to answer that. Anybody in the comments want to answer whether or not you're hearing a buzzing or a bad echo? They don't want to answer. Because if I am, I'll just stop this show and start over again tomorrow, because I don't want to have a bad piece of content out there. I can go over all this stuff again. I would say that by the fact that we are not getting a response, all right, then I'm just going to shut down the show. I'm going to shut down the show and start over again. Do it tomorrow. Good on your end. Then what the hell? Oh, no. Oh, that was weird. We had a delay on all this. No echo here. You're good. Okay, good. All right. So credit spread. We put these credit spreads on now, and I'm going to make the same case with a butterfly. All right. So credit is a misnomer. It doesn't matter if you put on a credit spread or a debit spread. They behave exactly the same. All right. But let's assume that we put on a put credit spread. So we have a short and a long put, and we have something like a 1-to-1 risk to reward. And then our profit curve will look something like this. And so when we put that trade on, I'll draw it a little bit different. So if you put it on right here, right at the money, that's a pretty good position to be in, right at the money. Really, you'll have a 1-to-1 risk to reward. Now you could increase your probability of profit. Now this would give you about a 50% win rate, because there's about a 50% chance that starting here that you're going to go in the profit tent, which is over here, or out of the profit tent, which is over here, unless you have superior knowledge on which way the price is going to go. So that's interesting. All right. The real key here then is that the risk to reward, it's about even. This is going to give you a distribution of returns that is really mediocre. You're going to win about as many as you lose, with the sizes being approximately the same, unless you can somehow manage to reduce your losses on this side. But from an options point of view, you wouldn't want to do that. You wouldn't want to sit there and then try to manage your risk on that side. That's what an option is all about. You can define your risk. So one way you could define it is this way. You could take that same trade and you can push it out of the money somewhat, so that the trade actually looks like the following. If you push it, let's say that the price is right here, you can push it out of the money like this. So now you have a nice risk to reward situation where your risk is very small, maybe 1 to 5. And so your profit curve will look something like this. Now, of course, the problem here is this really requires that starting here, you have to make sure you go here, this way. And while there's a way to make profit by, if you move far enough here before you get into the profit tent, you can still make profit around here, but it's relatively small, and price is always moving against you. This real-time profit curve is always moving against you. And so you really need to get over into that profit tent relatively quickly. So that's one way you can do that vertical. Another way you could do it, part of this is the setup, right? Is you can do a high probability trade. A high probability trade would say, okay, let's say that price is right here, and I want to have a high probability that I'll stay inside the profit tent. So you'll do something like this. So you push the spread to the left, and now your profit curve. So now maybe it's high probability because the chances of you going outside of the tent is probably low probability, maybe as low as 5% to 10%. So that means that you have a 90 to 95% probability of winning this trade. So what is the problem with this? Let's say that you put this on in the morning, right? It's say 10 o'clock. You put it on right here. You have, let's see, you have 6 hours until the end of the day to be somewhere over here or somewhere right here. Anything outside of that, and at the end of the day, you're going to be a loser. But what happens in between? Let's suppose that in the very first 30 minutes of the trade, that the price goes down and you're sitting right here. So you're sitting there and you're still inside of the profit tent, but there's 5 hours to go in the day. And you're down, let's say, I don't know, $300 or more, maybe $500. And your max loss is going to be like $700. And you're afraid that you're going to get outside here because you're only just a few points away from getting to inside the max loss area that's out here. How's that going to make you feel? Sure, you put it on at the beginning and it was a 95% probability, but now you're sitting there facing the possibility of having a monumental loss. Now your win, if you stayed inside there, maybe you'll make, I don't know, $50, maybe 100. But now you're 300, maybe $400 down because of a quick move to that side. Now, of course, it could move this way too, and that would make you feel good, but it will go this way many times as well. And now it doesn't feel like a 95% probability trade. In fact, once you move that quick move to the left, the odds of you winning that trade now have decreased from 95% probability to whatever the odds are from where you are at that point. Now you're underwater, and now your odds of winning the trade are significantly less, probably gone down to maybe 50%. That's the problem with these high probability trades, is that if they go against you, sure, if you had the resolve to stick with it and say, I am going to stick with this trade because I know that if I just stick with it, eventually I will realize the 95% probability, which nobody does. Nobody, because when you're in the thick of it and you're analyzing your position from moment to moment, this is the reality. This is your reality at 11 a.m. in the morning. You got into this trade thinking you have a 95% probability trade, but now at 11 a.m., you have a 50% probability trade and you're $300 down. That's the reality of high probability strategies. Half the time, you're going to be put into peril, what appears to be peril. And as you're going further and further into that unrealized loss, now what do I mean by unrealized loss? You don't have a win or a loss until you close the trade. So when I say unrealized, that means that you haven't closed the trade yet. And so it could come back, or it could get worse. Or you could let it go into expiration. But an unrealized loss means simply that you haven't closed the trade yet. Now, you could think that I have a credit. That credit is also unrealized. And it's worse than an unrealized win or unrealized gain, because you don't have any gain. You just have a credit for a gain in the case that you happen to go in the right direction. A credit doesn't really mean anything to a trader overall. It's whether you have an unrealized loss or an unrealized gain and the opportunity to close it so that you can then book it in your account. Till you book it, you have nothing. With a high probability strategy, 50% of the time you're put into a perilous situation where you are faced with a humongous potential loss. And that is because of this huge disparity between risk to reward. So I'll color the reward in green. So here's your reward, right? You'd be happy if you're up there, but it's tiny. And then here's your risk here. It's ominous. And I'll tell you, the scale that I drew this doesn't even show. This should probably be way down here. It's probably more accurate. So you can see just from this point of view, if you're sitting right here in this target spot, sure, if you held on for another 6 hours, that price won't go down a few points, then you might get that tiny little reward. Otherwise, you're facing this massive loss, massive. What that creates is tremendous anxiety. That anxiety it manifests itself as fear and panic and making bad decisions. That's where you're at when you're in a losing situation in a high probability strategy. Half the time you are ridden with fear and anxiety and the prospect of making really bad decisions because of that problem, right? Because you are in peril of having this massive loss that could literally wipe out a week or 2 weeks worth of your gains, maybe more. Now, what some people will do is they'll say, I could get into the trade again and then double down and add to it and then reduce my cost basis. But that's not going to increase your probability of profit any. All that does is add to the trade and maybe changes the risk to reward scenario a bit, but it hasn't changed your probability of profiting, and it hasn't changed your chances of having that catastrophic loss. So no matter how you look at it, this high probability strategy is not such a great deal. And that's because of the panic and the fear that it introduces that causes you to go apoplectic and make bad decisions. How would you feel like if you're there and you have a risk of losing half your account? You're going to panic. You're going to take wild chances or do something that is not recommended. High probability strategies are really a canard, and it's the shiny jewelry or trinkets that you throw in front of unsuspecting retail traders that don't really understand the dynamics of this, or that they've been sold a bill of goods that somehow high probability strategies are the way to go. High probability strategies. Okay, let's get real here. What is a high probability strategy really all about? First of all, if you do the math, a high probability strategy has negative expectancy. All right, so I'm coming up. High probability strategy has negative expectancy. A low probability strategy with high potential reward has a positive expectancy. In other words, if you did 1,000 trades and everything else was being equal, the high probability strategy would be a loser, and the low probability strategy would be a winner. But it doesn't make intuitive sense when you're first getting into it, because you just think win rate. I need win rate. That's going to get me to nirvana. What you don't see is all of the anxiety and panic and volatility that you have to go through to go there. That is guaranteed it will get you off your game and make you make bad decisions that you normally wouldn't have made. If you were a machine, you could say, I'm just going to hold, and then I'm going to take my losses, and I'm going to deal with them, even though it's going to create incredible volatility in my account and huge drawdowns and make it more difficult for me to come back. That's what I'm going to do, because the odds say that there's only about a 15% chance that I'm going to wipe out my account or a 20% chance or whatever it is. And you're willing to take that risk. In the meantime, you're going to be sweating bullets. Well, the good side of it, the winning a lot of little times, is something that has been sold throughout ever since online brokerages have been out. Now, I've been in this business right from the beginning. In fact, I helped one of the very first online brokerages get online. When I say help, I was the implementer. I was the technical guru that brought together all of our technical resources, the management of the company, engineering, security, and everything else. And then we deployed those systems onto the net. I also work with all the brokers and all of the ancillary people around that. This was with Fidelity and many others. And I've been in the meetings where the C-level folk, the chief investment officer, the executive officers are extolling exactly what their primary goal here is with this system. This system is, first of all, it had to be bulletproof, right? So that no one would fear the software itself or the execution of trades. So that's great. That's a good part about it. But they wanted to create an environment, create an educational environment, educate their customer on how to be the best possible customer for the broker. What do you suppose that the best possible customer is for a broker? Obviously, that's the one that's going to make the broker the most money. So do you think that it is in the broker's interest to care whether or not the customer makes money, if that is not contingent upon the broker making money? What would be the best possible situation for the broker to make money from the customer? That would be the only way that the broker makes money, and that's commissions. A commission happens every time there's a transaction. Every time you push the button, buy or sell, open or close a trade, the broker makes money. They don't care if it's $1 million trade or a $2 trade, they make money. They don't care if you win or lose, they make money. They don't care if you blow up your account, because there's somebody that will fill your place almost immediately, and they also know that you'll eventually come back anyways because you're a degenerate gambler and you're going to come back anyways, and the broker will make money. So therefore, the broker is incentivized to do one thing, and that is to get you to push the button as often as possible. The high probability strategy was designed, the concept of it, the education, it was the perfect thing to teach people, to get them interested in trading and give them this fallacy that they can make a lot of money by having a high probability of winning. Therefore, all of their educational sources, resources, everything that's ever been out on the internet was ultimately financed by the broker so that you could be the best possible customer for the broker. It's called the broker narrative. And that narrative extends way beyond educational materials. It extends to all the analysts that you see on CNBC. They're doing exactly the same thing. They're out there trying to promote stocks and bonds and assets, or whatever it happens to be. It doesn't matter what it is, to get you interested in pushing buttons. They don't care if you win or you lose, because it doesn't matter. That is the broker narrative. That is the primary push of all brokers, is to get you to push buttons. And they go through this broker narrative in many creative ways. And probably the one that's been in your face, if you're a retail trader, that you can see directly is Tasty Trade, or they call themselves Tasty Live right now. Now, when Tasty Trade first came out, it was started by a fellow named Tom Sosnoff. And he started originally the Thinkorswim trading platform, which he eventually, and it's a great platform. And then he eventually sold that to TD Ameritrade, and ultimately it was sold to Charles Schwab. But he made a lot of money from that. And then with that money, he made hundreds of millions. He took that money and he wanted to start another brokerage because he saw that this was his formula for making another few $100 million. And so he started very unsuspecting and of course, he's putting it right out in your face. This is exactly what all brokers are doing, by the way. They decided to give away information, very high quality information. Brilliant move. Attract as many people as possible into the Tasty Trade way of doing things. Show them how to put on as many high probability strategies as possible all at once. And they're going to give you education, free education on how to trade options, how to trade futures, how to trade stocks. They'll show you all these different strategies. They'll give them fantastic names like the Iron Condor and Jade Lizard and everything else. This is precisely what they're trying to do. They're trying to fantasize the idea of trading and get you to buy into the idea of putting on tons of trades, small trades. They would teach you all about probability of profit and return on capital, which they reduced down to pop and rock. They taught you how to trade options. They would give you statistics. Those were the best. And I'm not saying that they're lying on any of their statistics. They're all designed around to give you the illusion that putting on and setting up your pop and rock, in other words, defining your deterministic outcome. This is really the fallacy. Defining your deterministic outcome by defining every trade that you put on, the probability of profit you put on, and the return on capital. And they say if you do this through the law of large numbers, that you will eventually hit your trading nirvana. And so, okay, that sounds great. They taught you all this information. They also, at the same time, showed you how to be the best possible customer for what was eventually going to be the Tastyworks brokerage. They first started out with an experimental brokerage, which was online, called Bob. And Bob was nothing more than an iPhone application that allowed you, that you would get alerts, constant alerts for all these different trades. And what you were supposed to do is just keep on clicking on them and trading them, trade. But Bob didn't work out so well for whatever reason. Poor implementation, it was slow, whatever. Then they started with a brokerage that they thought, oh, we'll attract them with social media. And so they started this other platform called Doe. And so they thought they could attract you all into their Doe platform and get everybody start buzzing back and forth with all these trades that you could trade. Push buttons, push buttons, push buttons. And that didn't work out so well either. Probably a marketing faux pas. Then they finally came up with Tastyworks. Tastyworks was the glitz upon all glitz. It was the trading platform that simplified trading. It made it easy to push buttons. It was all drag and drop and very graphical. It had limited capability and it wasn't very good at analysis because they weren't interested in you getting in there and getting into the weeds and really understanding the trades. But they made it appear as if it had enough that was good enough for what you needed to do, enough so that you could push buttons. So they set this up over a multi-year. First, they gave you the education, taught you how to be the best possible customer, and then handed you the brokerage. Now you would then be there to be the best possible customer to Tasty Works. Works isn't an anomaly. That's the way all brokers behave. It's the way all brokers have behaved from the very beginning. They're all trying to get you to do the high probability strategy. So that's basically what I'm fighting against every day, trying to help people realize that the high probability strategy is the canard. It is the canary in the gold mine. It is the thing that is trying to attract you into all of this hype on how you're going to become rich, but you never do, because you're going to find out very soon that once you get into these trades, you're placed in peril. Your anxiety level is going to go through the roof. They're going to tell you then it's because you haven't learned yet how to control your emotions or do the proper risk management. And then they develop a whole industry around that to help resolve all the problems that they've created with high probability strategies that you just haven't gotten there yet. You haven't figured it out. Meanwhile, back at the ranch, all the pro traders that are working for the brokerage, what are they doing? What are the pro traders doing? Just what are the pro traders doing? And the day trader, 98% of all the day traders are losing. 98%, including you. Or not winning, I should say. The pros, they're winning. Why? Primarily because they're doing exactly the opposite of what you're doing. They're doing precisely the opposite of what you have been culturally conditioned to do, the broker narrative. That is why the pro is winning and you're losing. So the pro is not thinking about win rate. The pro thinks about one thing only, and that is return on capital efficiency. What's the minimum amount of money that I can put up and receive the maximum possible return? And can I do that efficiently and not allow myself to go into a drawdown or get into a perilous situation or feel that anxiety? How do I do that without feeling like I'm falling off of a cliff, the edge of a cliff? Right? What do I have to sacrifice to do that? What do I have to concentrate on so that happens for me? If you think about it, and when I say they did the exact opposite of what a retail trader does, then it becomes clear. They're not doing the high probability strategy. They're not focusing on win rate at all. It might be an item in their trade log, but that's about it. All they really care about is their capital efficiency. What is their actual return as a percentage of their drawdown? What is their return as a percentage of their average trade? What is their average loser to their average winner? That's what they care about. They're trying to constantly maximize those numbers to be as efficient as they possibly can, to put themselves in the most comfortable position that they possibly can and maintain their status, their wealth. That's because they realize that trading isn't about extracting daily profits, a fixed amount every day. You hear this idea that you somehow can create income from an option strategy, which is the biggest lie in ever in trading history. You cannot create an income with trading, implementing any particular strategy. That's because an income, that implies that you're going to be making the same amount and that you need that certain amount, just like a job, to pay bills. Trading doesn't work that way. The market isn't there to give you a metered amount every week, every month, every year. In fact, it is exactly the opposite of that. You're given opportunity based on what the market decides when it wants to give you that opportunity, and that opportunity is going to be distributed all over the place. Most of those opportunities are going to be small. Some of them will be medium, and a much smaller number of them will be large. But they won't be regular. They won't be income-like. So a pro adjusts their strategy to be compliant with that reality, that the market is doling out things in a random nature, and then you, as the trader, need to be there in the game all the time, because you don't know when those opportunities, if it's going to be a winner or a small winner or a loser or a big winner. You need to be there all the time. And if you're going to be there all the time, you can't put yourself at risk. You cannot afford to drop your capital down or have a big drawdown and put yourself into risk and make it difficult for you to stay in the game, both mentally and physically. Capital just can't do it. But you have to be in the game. So the only way to stay in the game is by putting in small profit, a small risk, a tiny bit of risk. That way you can meter out your trades. You can do that all day long, all week long, all year long. And then make sure that you set up your trade in such a way that small risk has the potential to return very large returns. And now you have a spectrum of returns from small to large, where the retail trader has no spectrum. It's just small. In terms of losses, it's small to large, but in terms of wins, it's just small. So therefore, the retail trader also can't scale. They can't get bigger, because in order to get bigger, they have to add tremendous amounts of risk just to get a small incremental bump in their potential win, where the pro has to just incrementally increase their risk for a tremendously larger amount of potential profit. So like I said, they do the exact same thing. They're trading, but they do it in exactly the opposite way. One is winning, the other one's an abject loser. So you decide, what do you want to do? Do you want to do it the way the pro does or the retail trader? And this is really what we're going to predicate all of the analysis of all the strategies that we're going to look at over the coming months, weeks and months. We're going to look at each strategy for what it will feel like while you're in the trade. Will you feel anxiety or not? Will you be encumbered to do these sort of draconian gymnastics, these mental gymnastics, in order to just try to manage your risk? Or will you not care about risk at all and then put all of your positive energy into making profits? Oh, let's see. Lance wants to know, just read Tom Hogarth's book, and he spoke about adding to winners. How does that translate to the 0 DTE flies? Add more spreads, widen mental stop loss, add deltas. No, it's just exactly what I just described here. You can scale yourself. Now, he's the type of trader that is adding to his winner in the course of a trade. And while that is impossible when you're starting out with a fixed potential profit, what you can do is you could add to trades, but it's not in the same manner that Tom does. But you can scale with minimal risk. That book from Tom, the Best Loser Wins, I think that's the book that you're talking about. He's really talking about, his primary focus is on how you handle your losses. I think it's The Best Loser Wins. How you handle those losses and your expectation of what your losses should be, and then playing to that game, understanding that you could have a large number of losses, and if you are going to have a large number of losses, make sure that they're small and contained, and they get you closer to your goal. I don't think that there's a direct translation to the way he trades, where he's doing momentum trading inside of a particular asset type, and that would be Forex, where, unlike most traders that will sell into their gains, he does the exact opposite. He buys more into his gains. So in other words, as your market is moving up and advancing, instead of shedding off your profits, he's adding more to it. He's adding more to the position as it's going up. And there are some parallels to that, but not in a discrete way like that. Overall, with the strategy, you can mimic that. But you can scale this way. You cannot scale the retail way. All right. That's it for today. Tomorrow, we're going to go deeper into these strategies like the credit spread and the iron condor, the butterfly. We'll look at the Jim Olson butterfly. We'll look at the Tammy Chambliss iron condor, and we'll juxtapose that to what our system is, and that's the out of the money butterfly. And then you decide whether or not we're doing something that's more akin to what a pro trader would do or a retail trader. All right. Thank you very much. Peace to you all. Time for music. See you tomorrow.